Hi everyone, we're going to watch a video right now of how we found the RSI filtered top 30 US CFD stock pairs, and we're going to look at a specific pair in that group of top 30, which is GS versus RJF. That's Goldman Sachs versus Raymond James. But first, let's just talk quickly about what it means to you to join the PairTrade Finder community. So once you've done that, like thousands of other traders before you, the first question you're going to have when you open up PTF Pro is, how do I find profitable pairs to trade? Well, you can relax, not too much because we're in trading, but we've done the heavy lifting for you. So our team invests hundreds of hours every 2 to 4 months, about once a quarter, to create and recreate a trampoline for you to spring into action when you subscribe. A weapon in your arsenal to help rapidly achieve consistent profitability. What we do is, instead of just giving you our acclaimed software platform for finding pairs to trade and for calling signals and monitoring and calling signals on those pairs, we preload your copy of PTF Pro with 30 RSI filtered US equity pairs. Okay, we'll get into the filtering in a second, but we've carefully curated those, and we're going to show you how we do that. Most importantly, over the last year, these top 30 have generated trading signals in backtesting that show 49 closed trades, 96% win rate, average win of $310 per trade, average loss, of which there were only 2, of $51 a trade, average reward risk of 6.1 times, and a total net profit after commissions and slippage estimates of $12,797, and that's based on a hypothetical minimum $15,000 account size. And in this analysis, we've assumed trading at $5,000 a leg and 5-to-1 CFD margin. What that means is, with that profit figure, net of commissions and slippage and net of broker interest, using CFDs, that's about 5% per month in return over the year averaged out. So before we get into Goldman Sachs versus Raymond James, let's quickly just look at what some of our customers have said about PairTrade Finder and our curated stock pairs. I'll look at 2 or 3 of these. You can read them all on the slide if you like. Mitch Weiss wrote to us. He said, I used to manage a prop firm in the 80s. We had over 1,000 traders. We did a lot of pair work back then. You have an excellent program. I've been testing your top 50 pairs. We used to do 50, sometimes we do 30, for about a month or so, and it is doing quite well. Then we have a quote from Chris Stone. I'm amazed that more people are not using your software. I've managed to make at least $8,000 in the last 3 weeks. I credit that to you, your staff, the great videos, and the excellent software. Let me say I love your product and I intend on being a lifelong user. I'm truly grateful. Thank you, Chris. And then over here from Les Cosiol, just to say how delighted I am with your product. For the first time in 10 years, I'm consistently profitable. If I can sort out my discipline and stick with the signals, the results would be even better. Yours eternally grateful. So we wanted to just give you a snapshot of what some of the unsolicited emails we get from people and what they're telling us about our top 30 and about our software platform. So how do we do this? How do we create the top 30? Well, the latest batch, which is preloaded into PTF Pro when you subscribe today, over the next few days, are RSI filtered, and they're large mega cap top 30 US equities pairs. So each top 30 pair has met stringent historical return and co-integration hurdles, and it must pass a basic fundamental screening. So very quickly, they're all US, NYSE, Amex, NASDAQ. These ones are much larger, are all at least 5 billion market cap. Most of them are over 10 billion, so these are the large mega cap pairs. And they all have over $10 million of daily average traded volume, so they're easy to borrow. We do a fundamental screen, same national market, same sector, usually same industry subgroup. Then backtest parameters. How do we set the backtester to determine what we're looking for in terms of a good pair to trade? Well, we look back 3 years. We set the lookbacks for standard deviation, stretch, and ratio at 63-day lookbacks. We enter at plus or minus 2.7 standard deviations, and we exit at plus or minus 1 standard deviation. We include 10 basis points commission slippage per trade, that's per leg per trade, and we put a time stop of 60 days max days in trade, and the backtest are set at $5,000 a leg. And importantly for these pairs, okay, the RSI filter has been applied. We use an overbought oversold of 70-30 and the RSI 14 days look back. This results in fewer trades, but we think potentially better reward to risk. All trade screening, additional filters have pros and cons. The thing you're hoping to achieve is to get better trades, but there obviously will be fewer of them. So we don't have the same kind of frequency in this set as we do in the top 30 or fast 50 sets where we don't use an RSI filter. So then we run the backtest, and what are our backtest output selection filters? Which pairs do we choose? Well, they got to be co-integrated. So here's our definition: co-integration. They've got to make at least $150 per trade, and usually we want it to be over 200. That's based on 5,000 a leg. Okay, they got to have 4 trades over that 3-year period. Remember, fewer trades because we're filtering on RSI. We'd love this if there were 8 or 10 or 12, but we're just finding you're not getting them with the RSI filter in place. We want the compounded growth rate to be generally in excess of max drawdown, although with these fewer trades, what we're really looking for is a low max drawdown, and the target max historical drawdown is of less than 20%. Really, we're looking for something under 15 or even under 10, but this is our outside maximum that we'll tolerate. And at that amount, that would be $1,000 loss on a $5,000 leg trade. So you want to make sure you scale your account size or your leg size accordingly to maintain conservative position sizing. We want the pairs to show at least 70% win rate, preferably above 80%. And we want a target correlation of at least 50%. And we can maybe go a little lower than that if the pair is very co-integrated. However, really, we find the best results, the sweet spot, are over 50% correlation and co-integrated. Commissions and slippage, we want those to be less than 20% of gross profit. So that's how we choose our pairs. Now, let's take a quick look at Goldman Sachs and Raymond James Financial. This is one of the top 30. So Goldman Sachs Group, this is the fundamental snapshot tab of PTF Pro. Most people know this company. It's an investment bank. It does a huge amount of asset management, consumer and wealth management, mergers and acquisitions, restructuring, strategic and financial advisory services, and it also proprietary trading desk. Raymond James is a very similar company in terms of its activities, and it does underwriting, distribution, trading, and brokerage of equity and debt securities. It also does mergers and acquisitions, and strategic and financial advisory. So here you see that corporate clients, mergers and acquisitions, strategic and financial advisory. So they're fundamentally fairly similar businesses, although they always have quirks and differences. Arguably, Goldman Sachs client franchise is much stronger than RJF's, but they also target different size segments. But they do the same things, and mainly U.S. So what do we have? We have both financial sector, both capital markets industry subsector, prices of 4-to-1 ratio. That's fine. Beta on Goldman Sachs is 1.5, Raymond James 1.2. Bit of a differential there, mainly because of I think at least because of the debt equity ratio. Goldman is more than double the leverage of Raymond James, and that obviously results in a higher beta. Market cap. Yes, Goldman's much bigger, 133 versus 20, but that's within our tolerances. They're both still very large companies, and price to sales they're valued the same price to book. Ray J is valued higher than Goldman, and they both pay a dividend around 2%, and Zacks ranks them both in terms of earnings surprises and earnings quality at both of them at 3. Okay, so that's the quick fundamental screen we do to make sure that we're happy that these companies are fundamentally correlated. Then we run a back test, and in this case we got 6 trades. They were correlated at 75% over the back test period, average correlation. Co-integrated 0.93. The compound annual growth rate, had you left your money in this pair and only in this pair and in cash when it wasn't in a trade, would have been 11% with a max drawdown of 5. The gross profit for the 3-year period was $1,888. Commissions and slippage were pretty de minimis. Your average net profit a trade was almost $300. 83% were winners, and the average trade lasted about 12 days. Here you see the equity curve. One thing we don't like here is this big win. It's great to have a big win. Yes, that's fantastic. But this is a price shock, and this price shock happened back in 2020. And had we been on the other side of that trade, we might have had a big loss. We might not be looking at this. So have we selected a pair that was on the right side of a price shock? Yeah, maybe. But if you look at it, every other trade has also delivered pretty good results. And even the one they're calling a loss I think it was a $2 loss. Okay, so you've got 5 other trades, all of which were making decent money. Okay, so in that basis, we would say we still like the pair. You can see the ratio moving average is pretty stable over the 3-year period. The line is basically from about 3.75 and then it ends at about 4.2. So, very stable. We like that. Quickly, this is how we can review this in pair charts. Here's a trade that was called back on the 4th of April. And it was to go long Goldman at 320, go short RJ at 85. It was negative 2.92 standard deviations. You can see that here on the plus minus chart. The ratio was here, well extended from its moving average. On the percent from mean basis, it was also below what we considered a support line. So that looked like it was quite extended. And on the RSI, it was well extended. It was 15. So you might have looked for divergence, okay, in the RSI. We don't see it here. If you wanted to have a divergence in order to take the trade, you might not take this one. If you're willing to take trades without a divergence on the RSI, you would have taken it. Anyway, it was a great trade. 1, 2, 3, 4, 5, 6, 7, 8, 9 days in the market. Gave you $226 in net profit on your 2,000 of margin that you deployed. So it was about 11.5% in 9 days. Great trade. So yeah, that's one of our top 30. The rest of them, here's a summary of how they did. We quoted those highlight figures at the beginning of this presentation, but 49 trades, 96% winners, 6-to-1 reward to risk. Gross profit of 14,848. We've used AvaTrade margin rates here of about 5% per annum, and based on what we would consider to be a highly levered account, 5-to-1, you paid about 2,000 in margin over the year, and your net was 12,800, about 5% per month. So those are the summary results. Again, these are large mega caps, so high volume, easy to borrow. And the entry stretch is plus minus 2.7, exit plus minus 1. There's 57 tickers in the top 30. There's almost no duplication. There's many industry subsectors, so there's good diversification across there. There's a few higher volatility pairs. Always check your volatility reading and position size accordingly. And always, we like to remind you, don't trade raw signals. Check the news to filter out signals deriving from fundamental value shifting events, and avoid earnings releases and dividend dates if the two securities have divergent dividend rates. Okay, so that's the top 30. Hope you enjoyed that. And we have to give you this little disclaimer and notice, but we have a great promo going on right now. There's a couple of days left on it, so if you want it, now's the time.